In this week's market update, investors are spooked by escalating trade tensions, OPEC agrees to pump more oil, and EU leaders meet to focus on Brexit and immigration. A broadening and escalation of the ongoing US-China trade war is top of the agenda for investors this week, as the Trump White House raised the stakes over the weekend. The latest salvo, expected to be confirmed later this week, is a restriction on Chinese investment in US firms in sectors from aerospace to robotics that China has said will be its main focus in the years ahead. Although attention has focused on the tit-for-tat tariffs already announced by both sides, the investment restrictions could mark an even more damaging reversal of globalization. They represent a huge change to the US's open investment regime. Chinese investment has already fallen recently as the Trump administration has presented a less welcoming face. According to the Rhodium Group consultancy, Chinese direct foreign investment in the US fell by more than 90% in the first half of this year compared with 2017. In 2016, before the presidential election, Chinese investment in the US hit a record $46 billion. In the first 6 months of 2018, it was just $1.8 billion. It's unclear how quickly measures would take effect or what their scope would be, but they're likely to cover the 10 sectors of the future which China has highlighted in its long-term planning. Trump and his more hawkish advisors are convinced that China has been stealing US intellectual property for years. Whether the US's protectionist approach will result in a lower trade deficit or more US jobs in the long run is debatable. The counter-argument, held by almost everyone outside the White House, is that no one wins a trade war. There are only losers. A study from the Peterson Institute estimates US job losses from these measures at more than 600,000 over 1 to 3 years. What is certain too is that the imposition of tariffs will increase inflation in the US, forcing the Federal Reserve to raise interest rates faster and further than it might otherwise have to do. Trump's protectionism is politically, not economically motivated, but it might end up being bad politics as well as bad economics if the biggest losers from his policies turn out to be his own cash-strapped supporters. A good example of this is the decision by Harley-Davidson, the iconic US motorcycle manufacturer, to shift production out of America to avoid retaliatory EU tariffs. Far from protecting US jobs, protectionism is actually hitting them. The market reaction to the weekend trade war stories was marked on Monday. The yen, which tends to be a safe haven in times of geopolitical stress, rose above 110 to the dollar, its highest level in 2 weeks. US Treasury bonds are also in favour, with the yield down 2 basis points to 2.88%. And the renminbi weakened to a new 5-month low at 6.5 to the dollar, after Beijing announced a $100 billion cut in the amount of capital banks are required to hold in reserve. The move is designed to boost lending and to cushion the impact on the Chinese economy of US tariffs. Equity markets were also hit. The FTSE 100 fell by more than 2%, with mining stocks hitting a 7-week low on fears that a trade war would hit demand for commodities. The London benchmark was also dragged lower by its high exposure to the oil sector, with the price of crude dipping after OPEC agreed to raise production levels last week. In Europe, the main focus was on the auto sector, with investors concerned about the impact of a proposed 20% tariff on car imports from the EU. Car makers and associated businesses making tyres and brakes, for example, were all sharply lower. The Frankfurt DAX index was down more than 2%. Later in the day, Wall Street fell sharply by more than 3% at one point, before recovering to see the S&P 500 close 1.4% lower. And overnight, Asian markets picked up on the US tone, with falls across the region. The OPEC decision had been well flagged, but the oil price nonetheless fell by more than 1%, as investors prepared for a further 1 million barrels of oil a day as producers agreed to increase output to balance the gap between supply and demand, which had pushed crude to a 4-year high recently. Brent crude, which had been above $80 a barrel, is now trading at under $75, although some market watchers expect continuing constraints as many of the world's biggest producers are not in a position to raise output. Iran, for example, has been hit by US sanctions, while deep-seated problems in the Venezuelan economy have caused supply disruptions there. Even the biggest producers, like Saudi Arabia, have practical constraints on how much extra oil they can supply, so the oil price is likely to remain supported for now. US shale is also coming up against distribution and storage limits, preventing further production. The other big news this week is likely to be the EU summit, at which Britain is hoping to make progress in securing a favourable Brexit deal. Unfortunately, Prime Minister Theresa May is struggling to put together a proposal on the biggest sticking point, a post-Brexit customs arrangement that will be acceptable to either hardliners in her own party or the other 27 EU states. The failure of the Brexit negotiations so far was thrown into stark relief by Airbus, the most obviously pan-European business in the region, which warned that it may soon be forced to shift UK production to other European countries or even its manufacturing sites in China and the US if a satisfactory Brexit deal looks unachievable. BMW and Honda have also expressed concerns about the impact of Brexit on the car industry's complex and time-sensitive supply chains. Honda's Swindon plant stores parts for only 36 hours of production, and it's the Japanese company's only European production site. Businesses in the UK are becoming increasingly frustrated with the UK's internal divisions and the government's apparent lack of attention to their requirements as the talks drag on. With Europe increasingly distracted by its own immigration tensions, the negotiators on the other side of the table from the UK are looking less likely to give way, and the summit on Thursday and Friday seems unlikely to come up with anything positive. The clock is ticking as the March 2019 deadline for Britain to leave the EU looms large on the horizon. EU leaders may be forgiven for thinking that they have larger fish to fry than Brexit, now as they struggle to respond effectively to Donald Trump's increasingly confrontational presidency. As well as the ongoing trade dispute, issues in focus this week will include a common asylum policy, reforming the Eurozone, and migration. And this remains the most contentious issue, with German Chancellor Angela Merkel's position under threat as hardliners in her ruling coalition seek stricter curbs on free movement in the region. Italy, meanwhile, is taking an increasingly aggressive line under its new populist coalition government, and Austria is taking over the EU presidency, promising to promote a hard line on immigration. Meanwhile, in Turkey, another nationalist hardliner, Recep Erdogan, secured victory in Sunday's general election, which he plans to use to push through a significant increase in the president's powers. Eliminating the role of prime minister, he's effectively ushered in an era of one-man rule. The Turkish lira, under pressure recently, rallied initially but soon fell back again as investors assessed his unorthodox views on interest rates. Unsurprisingly, in these circumstances, a mini rally for sterling last week on the back of heightened interest rate hike expectations soon fizzled out this week. Rather than focusing on a likely rate rise in August, investors are now fixated on the government's disarray on Brexit and the consequent lack of investment and sluggish economic growth it has led to. In the first quarter of 2018, the UK economy grew by just 0.1%. That's the slowest rate since 2012. And the pound is trading at $1.32, well down on its recent peak in April of $1.43. On the economic front, the focus is on America this week, with inflation data likely to be the highlight. Price rises are edging higher, while the core personal consumption expenditure measure expected to rise to 1.9% annually, up from 1.8% previously and 0.2% higher month on month. The Federal Reserve has indicated that it will probably raise rates a total of 4 times this year as it starts to lean against rising inflation. And finally, one of the stock market's great anomalies, the Dow Jones Industrials Index, passed a notable watershed last week when it was announced that General Electric has been ejected in favour of Walgreens Boots Alliance. GE was the last remaining stock from the original Dow Jones list of 30 leading stocks in 1896. Its passing is a comment on the reduced importance of industrial stocks in the US's service-led economy. The Dow is, of course, only a historical curiosity these days. Although still widely quoted in the media, hardly any real money depends on its performance, unlike the broader S&P 500 index, which underpins literally trillions of dollars of passive investments.